Welcome to Muscular Brain, Fat Wallet, where we help you make smart financial decisions to grow and protect your wealth. In today's video, we're diving into one of the most reliable investment options for generating steady income, bonds. While they're often considered more conservative than stocks, bonds offer essential benefits, especially for investors seeking stability and regular cash flow. We'll explore what bonds are, the different types available, and how they can be a powerful tool for generating fixed income. Section 1. What are bonds? To understand bonds fully, let's start with the basics. A bond is essentially a loan that you, the investor, give to a government, corporation, or other organization. When you buy a bond, you're lending money to the issuer in exchange for regular interest payments, also known as coupons, and, eventually, the return of your principal when the bond matures. This predictable income makes bonds a preferred choice for risk-averse investors and those seeking reliable cash flow. 1.1 Key bond terms to know. Before we explore the types of bonds, let's clarify some important terms you'll come across when investing in bonds. 1. Issuer, the entity that issues the bond, such as a government or corporation. 2. Principal, the amount you lend to the issuer, also known as the face value of the bond. 3. Coupon rate, the interest rate paid to you, the bondholder, typically expressed as an annual percentage of the face value. 4. Maturity date, the date when the bond will mature, and the issuer will return your principal. 5. Yield, the bond's overall return based on its coupon rate and purchase price. Understanding these terms will make it easier to navigate the bond market and select the right bond investments for your portfolio. Section 2. Types of bonds. Bonds come in various forms, each with unique features, levels of risk, and return potential. Here's a rundown of the primary types of bonds available to investors. 2.1 Government bonds. Government bonds are issued by national governments and are typically considered some of the safest investments available. When you buy a government bond, you're lending money to the government, which promises to pay interest and return your principal at maturity. 1. Treasury bonds, T-bonds, issued by the U.S. government. They have maturities of up to 30 years, and offer semi-annual interest payments. 2. Treasury notes, T-notes, shorter-term bonds with maturities between 2 and 10 years. 3. Treasury bills, T-bills, these are short-term bonds with maturities of less than a year, and they don't pay a fixed coupon. Instead, they're sold at a discount and mature at face value. For risk-averse investors, government bonds are highly attractive due to their security. They're often used in conservative portfolios to add stability. 2.2 Municipal bonds. Municipal bonds, or munis, are issued by state and local governments. They're unique because the interest earned is typically exempt from federal income taxes, and sometimes even state and local taxes if you live in the issuing state. This tax advantage makes them appealing to investors in higher tax brackets. 1. General obligation bonds, supported by the issuer's taxing power and considered very secure. 2. Revenue bonds, secured by revenue from a specific project or source, like tolls or utilities. Municipal bonds are often used in income-focused portfolios, especially for those seeking tax-free interest income. 2.3 Corporate bonds. Corporate bonds are issued by companies to raise capital. They generally offer higher yields than government bonds to compensate for the increased risk. 1. Investment-grade bonds, issued by companies with strong credit ratings and are generally lower risk. 2. High-yield bonds, junk bonds, issued by companies with lower credit ratings and offer higher yields to attract investors. Corporate bonds can add income potential to a portfolio, but investors need to evaluate the issuing company's financial health carefully. 2.4 International bonds. International bonds are issued by foreign governments and corporations. They offer portfolio diversification, but they also carry risks such as currency fluctuations and political instability. 1. Sovereign bonds, issued by foreign governments. 1. They can be stable investments but are subject to currency and geopolitical risk. 2. Foreign corporate bonds, issued by companies outside your home country. These bonds may offer higher yields but with added risk. International bonds can help investors diversify, but it's crucial to be mindful of currency risk and the economic conditions of the issuing country. 2.5 Mortgage-backed and asset-backed securities. These bonds are backed by pools of assets, such as mortgages or auto loans, providing cash flow from the underlying asset. 1. Mortgage-backed securities, MBS. Backed by a pool of home mortgages, these bonds offer monthly payments from the principal and interest of the underlying loans. 2. Asset-backed securities, ABS, similar to MBS but backed by non-mortgage assets like car loans or credit card debt. These securities can offer higher yields but carry specific risks, especially related to the quality of the underlying assets. 2.60 Coupon bonds. Zero coupon bonds don't make periodic interest payments. Instead, they're sold at a discount and redeemed at face value at maturity. They can be advantageous for long-term goals, as investors know exactly how much they will receive at maturity. Section 3. Benefits and risks of bonds. While bonds are generally considered safer than stocks, they come with their own set of benefits and risks. 3.1 Benefits of bonds. 1. Predictable income. Bonds provide regular interest payments, making them ideal for income-focused investors. 2. Capital preservation. High-grade bonds can be safer, making them suitable for preserving wealth. 3. Tax advantages. Certain bonds, like municipal bonds, offer tax-free interest. 3.2 Risks of bonds. 1. Interest rate risk. When interest rates rise, bond prices fall, potentially leading to losses if sold before maturity. 2. Credit risk. Lower-rated bonds carry the risk of default, which can result in losing part or all of the invested principal. 3. Inflation risk. Fixed interest rates mean bond income may not keep up with inflation. Investors must weigh these factors when incorporating bonds into their portfolios. Section 4. How to generate fixed income with bonds. One of the primary reasons investors turn to bonds is for the fixed income they provide. Here's how to use bonds effectively for generating a reliable income stream. 4.1 Laddering bond portfolios. Bond laddering is a strategy that involves buying bonds with different maturities. As each bond matures, the principal can be reinvested into new bonds, providing a steady stream of income and helping manage interest rate risk. Example, you might buy bonds maturing in 2, 5, and 10 years. As each bond matures, you reinvest in another bond to keep the ladder going. 4.2 Investing in high-quality, high-yield bonds. High-quality bonds from creditworthy issuers, like investment-grade corporate bonds, provide attractive yields with relatively low risk. High-yield bonds, or junk bonds, offer higher interest rates to compensate for their increased credit risk. Section 5. Tax-free income with municipal bonds. Municipal bonds can provide tax-free income, which is particularly valuable for high-net-worth individuals. Depending on your tax bracket, the tax equivalent yield of municipal bonds could be very appealing compared to taxable bonds. 5.1 Taxable equivalent yield formula. To compare tax-free municipal bonds to taxable bonds, you can use the taxable equivalent yield formula. The taxable equivalent yield is calculated by dividing the yield of the municipal bond by 1 minus your tax rate. This formula helps determine the yield of a taxable bond that would be required to match the tax-free yield of a municipal bond. 5.2 Example calculation. Let's say you're considering a municipal bond that offers a yield of 4%, and your tax rate is 25%. To find the taxable equivalent yield, you would divide 4% by 1 minus 25%. This calculation would show that a taxable bond would need to yield approximately 5.33% to match the after-tax income of a 4% municipal bond. Section 6. Constructing a bond portfolio. When building a bond portfolio, a few key strategies can help maximize income and manage risk. 6.1 Diversification. By diversifying across various bond types and issuers, you can reduce the impact of individual bond defaults on your portfolio. This might include a mix of government, corporate, and municipal bonds, as well as bonds with varying credit ratings. For instance, a well-diversified portfolio may contain investment-grade corporate bonds, which offer higher yields, alongside government bonds for stability. 6.2 Reinvestment. If you don't need immediate income from your bonds, consider reinvesting the interest payments into additional bonds or other investments. This compounding effect can help grow your wealth over time and increase your future income potential. Section 7. Monitoring your bond investments. Once you've established your bond portfolio, ongoing monitoring is essential. Here are key aspects to keep in mind. 7.1 Interest rate environment. Interest rates fluctuate based on economic conditions and monetary policy. When interest rates rise, existing bonds may decrease in value, so it's important to stay informed about market conditions. 7.2 Credit ratings. Regularly check the credit ratings of the bonds in your portfolio. Ratings agencies like Moody's and Standard & Poor's provide assessments of credit risk. If a bond's rating is downgraded, it could signal increased risk, prompting you to reconsider your investment. 7.3 Yield curves. The yield curve is a graphical representation of interest rates across different maturities. It can provide insights into future interest rate movements and help guide your investment decisions. A normal upward-sloping yield curve suggests a healthy economy, while an inverted yield curve can indicate potential economic downturns. Section 8. Tips for new bond investors. For those new to bond investing, here are some practical tips to consider. 8.1 Understand your goals before investing in bonds. Clarify your financial goals. Are you seeking income, capital preservation, or diversification? Understanding your objectives will help guide your bond selection. 8.2 Start with bond funds. If you're unsure about picking individual bonds, consider investing in bond mutual funds or exchange-traded funds, ETFs. These funds offer diversification and professional management, making it easier for beginners to enter the bond market. 8.3 Educate yourself. Continue to educate yourself about bonds and the broader financial markets. Resources like books, online courses, and financial news outlets can provide valuable insights that help you make informed investment decisions. Section 9. Common bond investment strategies. Investors often employ various strategies to maximize returns and manage risk. Here are some popular approaches. 9.1 Buy and hold strategy. This long-term strategy involves purchasing bonds and holding them until maturity, collecting interest along the way. This approach can be effective for income generation and capital preservation, especially with high-quality bonds. 9.2 Active bond management. Active bond management involves frequently buying and selling bonds based on market conditions, interest rates, and credit risk. While this strategy can generate higher returns, it requires more time, knowledge, and market insight. 9.3 Tactical asset allocation. Tactical asset allocation involves adjusting your bond exposure based on economic forecasts and interest rate expectations. This strategy can help optimize returns by capitalizing on changing market conditions. Section 10. Conclusion. Bonds offer a versatile way to generate fixed income while providing stability and reducing overall portfolio risk. With a clear understanding of the different types of bonds available and strategies like laddering, diversification, and reinvestment, you can create a bond portfolio that aligns with your financial goals. Remember, no single investment type is perfect for every investor, but bonds can be an essential part of a balanced, income-focused investment strategy. Whether you're seeking steady income through high-quality bonds or looking to capitalize on higher yields with corporate or junk bonds, understanding the bond market is crucial for making informed decisions. Thank you for joining us today on Muscular Brain, Fat Wallet. If you found this video helpful, please give us a thumbs up, subscribe for more financial insights, and let us know your thoughts on bonds in the comments below.